team. Good to see you. Question. Thinking of the New Zealand economy, if we would change the Reserve Bank settings in terms of capital requirements, have you guys teased out the amount of money that would be circulated in the economy? I've asked all the other banks that, they're never going to be an answer. You've got a sort of theory on what sort of money, if we went from a 200% to a 100%, would be added to the economy.
So one, we recognise that the balance of financial stability and impact on consumers is a tricky one to get. The way that we've looked at it is to say, if you took the average farm loan, which is about 4.4 million, and looked at what's the additional cost of that capital at the end of the capital track, we think that's about $20,000 per year for that average farm loan. So we can see that the impact of that is material. That's an amount that we've adjusted for competition. So we think the amount would be closer to double that if there were no competitive forces at play.
I could just add that the Reserve Bank at the time of implementation of the capital rules in 2019, they said in their estimates it was going to be 20 to 40 basis points, which as a cost to the economy, they estimated was 1.2 to 2.3 billion. Our own estimate is we think it's slightly higher than that. And taking into account, as Catherine said, some of the competitive forces, we think the impact's more like 50 basis points at the end of the build. So the build finishes in 2028 and we're about halfway through that.
So where we should today, if I was to ask you in plain English, do you think we should actually adjust those settings? Given that we've moved on from the 2019 sort of era, what would your answer be?
So I think your context of decisions were made in 2019 and we're now in 2025 is a really important context. In any business that I've been in, you tend to stand back and do a review and say, is the path that I set 6 years ago still appropriate for the way forward? So we think it's an entirely appropriate time to do a review. We've had COVID since those decisions were made, and it's also been interesting to see what other countries have done in other parts of the world. So if I look at it, we effectively have built in 3 levels of conservatism into what we've done with the capital track here. Firstly, that the CET1 ratio at 13.5% is higher than Basel recommended and higher than Aussie, which is going to 10.5%. Secondly, there's this thing called a scalar. Basel, it was originally at 1.06. Basel recommended that got removed. The Australians have put it in at 1.1. Here we've put it in at 1.2. And then thirdly, the way that risk-weighted asset settings have been done here, again, is different. And so we've got multiple layers of conservatism if you look at us versus most other countries in the world. Some of them have started to ease back on those requirements. And so we think it's a very appropriate time to do a review to say, are these fit for purpose for Aotearoa moving forward?
If I've got a couple of questions, Mr. Chair, if that's all right with you.
Yep.
Should we pull out the Zero Banking as alliance, given that we have seen movement around the world, including Māori Bank, in terms of mandatory climate reporting? Do you think, given the aspirations of this current government, that would embolden productivity?
So the first thing I would observe is that multiple governments in New Zealand have signed up to the Paris Agreement, and that as a country, there are things that we want to achieve as part of that. So us doing our part as a company, both as an individual company, but also supporting customers to make that transition is incredibly important. Westpac New Zealand is part of the Net Zero Banking Alliance through our parent company, Westpac in Australia, and at this point they have no intention of reviewing that commitment.
The final question I have, there's been a critique and criticism by some in the rural sector that the Australian farm loans and the requirements of mandatory climate reporting are less onerous than they are for the New Zealand counterparts. How do you square that away?
So a couple of observations. One is we have signed up to emission intensity reduction targets. The percentage reduction in New Zealand is less than in Australia, reflecting the strength of our farmers and how efficient we are already. The second observation that I'd make is that we put a sustainable farm loan into market, entirely voluntary. It has a interest rate difference on it. We did that a couple of years ago. Over 45% of my entire agri book is now on that product. And so that's telling me that there's a really good demand from New Zealand farmers for banks who are prepared to work with them and help, because there is a discount in their lending, to help them make that transition and reduce their emissions intensity.
The discounted lending, is it subsidised from another part of your statute books, as it were?
No, as I said to you, if I look at my return on equity over a period of time, our return on equity has decreased, and we haven't put prices up to other sectors. So it's purely something that farmers can volunteer into. They decide what their emissions intensity reduction is. We use metrics that they're using for other providers in the market. And as I said, if I see, if you had asked me when we launched it, would almost half of our book be on that within a couple of years, I probably wouldn't have believed the team. However, it's indicating something incredibly positive and unsurprising about New Zealand farmers.